Hello, Ivan. Today we will be talking about the investment models. As you all know that there are a lot of investment models through which a lot of investments that is coming to our country throughout the world and everywhere. So there are various way in which the government, the private people, the international players do the investment in various part of the world. Okay, so there are various model through which this investment comes through, right? So we will be understanding what is the meaning of investment, what is the meaning of investment models, how many type of investment models are there, what are the type of we will be also understanding what are the examples, like which type of investment model is being utilized at which place, right? And after that we will be also discussing the foreign direct investment. What is the meaning of foreign direct investment? Because that is also a type that is also a very big source of revenue to the government. And we'll be also talking about like in which places FDI is involved, which places government is trying to restrict it, and all the things, right? So we all will be discussing all these things in the investment model. So first of all, we will be starting with the very basics of the investment model. Okay, let's start with our session. So this is Indian economy investment model GS paper 3, right? So as you all know that in every video we discuss like what topic we are doing. So right now we are doing this topic, that is investment model. Okay, so we'll be discussing what is the meaning of investment. Whenever we are saying investment, that means some money is coming from some place. Okay, so there is a money. Okay, money is treated as resource. This money is coming from some places and it is being invested at some places in order to generate future benefits. Okay, so here the person who is sending the money, getting benefited, who is receiving the money, who is also getting benefited, and all the intermediaries are also getting the benefit. Okay, this is a flow of money that is being part or called as an investment. And investment people usually do in order to get future returns in the future, in order to get returns in future. Okay, like you do a saving bank account, you open fixed deposit, right? If you open a fixed deposit with the 7% interest rate, right, and you invested around 1 lakh rupees in that fixed deposit, so after 1 year you will be getting 1,07,000. That is your investment. You have done an investment of 1 lakh rupees for a future benefit of 7,000 rupees after a year. Okay, so this is like the money will be invested in various productive activities in order to earn income from those resources, from those assets and everything, right? So investment can be done directly either in primary, secondary or tertiary sector, or it can be done indirectly. Indirectly mean as in the form of financial securities. You buy the shares, you buy the debentures, you buy the bonds, you buy the mutual fund. Here you are buying these paper. Okay, and then like if you buy a share of 1 minute. Okay, if you buy a share of Infosys. Okay, so you buy a share of Infosys of 1,500 rupees. Okay, so you have given the money, you have not invested in any particular sector that you should invest my money at this place. Now Infosys will decide like how you are they are going to utilize this shareholder money in order to generate more and more returns to the shareholders, right? And sometimes people directly invest in the main source. Like if I have a land, I am investing in my land. Okay, so I am doing a primary activity, secondary activity, manufacturing, I am opening a company, tertiary activity like a service company I am opening. Okay, so here direct investment. But whenever I am buying financial security, shares, debentures, so we are just buying the shares, we are not dictating the company what to do. Okay, we are buying the shares. Now company will be deciding what they have to do with the shareholder money in order to generate more and more profit for their shareholders and more dividend to their shareholders, right? So how this concept of investment usually work, right? So here we have a person who is providing the money. Okay, then there is a people who will be giving their energy in order to find out where this money has to be invested. So all this process requires time. Okay, after a certain time, all the people, those who are putting their energies, those who are putting their money, and those who are putting the time, they will be getting future benefit. That is called investment. Okay. Now we are moving towards the importance of investment. Why exactly we are always looking for more and more investment? Why? What is the need? Why we are so in dire need of that investment? Why we need that investment? Why we are always looking for the money and the resources has to come from everywhere, right? So investments are very very crucial for the economic growth of the country, any country, wherever you go, any country, whether you go to first world country, third world country. Okay, that is the concept that is going on right now. Okay, wherever you go, investment is the major things through which the countries can go from underdeveloped to developing to the developed status. Okay, because of the investment only it leads to the economic growth because of the stimulated production. They create jobs, they boost the infrastructure development, and obviously in this whole process they foster the innovation as a whole. Okay, because whenever there are resources, whenever there are investment that are coming, automatically it will create production, automatically it will create infrastructure, automatically when the infrastructure will be created, it will be creating the jobs for that. Okay, and whenever the infrastructure and investment is coming, along with that innovations also comes, okay, in the form of technological transfers and various other things, right? So now infrastructure development, because we know that infrastructure is very more in, because of the infrastructure there is a capacity addition that happens. Okay, more and more infrastructure, more and more capacity building will happen. Like if we are investing in ports, roads, airports, railways, power plants, like now we are making power plants, so we from 1000 megawatts we are making to 2000 megawatt. Okay, there is a capacity addition, right? Railways, now we are catering to 10 lakh people per day, now we are catering to 30 lakh people per day. Capacity additions is happening. Ports and airports, more and more logistic facilities are getting created, more and more connectivity is getting created. Like if we go by the metros, malls, roads, and then rail and everything, you can see residential hub, commercial hubs are getting created everywhere, right? Then industrial growth, whenever the investment come, automatically it leads to the industrial growth, right? Because it will be, the money will be invested in the industry will be generating growth. Okay, you know, we are running right now our Make in India campaign, right? In Make in India campaign, 25 sectors we have selected, right? 25 sectors are there which are being selected in the Make in India. So in these sectors the money will be invested, they will be creating jobs, they will be creating productions, they will be boosting the infrastructure and everything. Automatically when the growth will be coming, automatically domestic and foreign investment, more and more foreign investment in various sectors, whatever the sectors are there. It can be automobile, electronics, pharmaceutical, whatever the sectors are there, whatever you can think, you can just generate the investment in that place and automatically it will turn around the whole situation at everywhere, right? So here I have just only mentioned certain sectors. Okay, there are a lot of sectors in which wherever the investment is coming, automatically right now, you know, we have a green energy that is going on. Okay, a lot of investment is coming. Pharma, in the area, in the vaccination. Okay, the whole investment is coming. Semiconductor sector, right? Semiconductor sector, a lot of investment is coming. So government is also creating a lot of policy: green hydrogen policy, green renewable policy, vaccination policies, then semiconductor policy. You know, 79,000 crore rupees semiconductor policy government has created. Okay, then automatically whenever the investment is coming, investment will lead to research and development. Obviously whatever the money that is coming, it will be also invested in various type of R&D activities. Okay, This will help in fostering the innovation. Automatically it will create, and it will also create a inclusive environment where they will be able to compete with their international player. Automatically this will boost the competitiveness of the market. Indian IT industry is one of the most competitive sector of the world, because Indian IT sector has already beaten the IT sectors of the world, right? We have a Tata, TCS, Infosys, Wipro, Tech Mahindra, and various other companies are there, which are the main competition. They are giving a lot of competition to the international player. Okay, so along with the investment, lot of innovation and technology also comes, and then this again technology is reinvested, and again it will bring out the values in the world, right? Then automatically whenever the investment is coming, it leads to the human capital development. Then how it is generating a human capital? Whenever the money is coming, money is invested in creation of educational institution. Whatever a type of institution, you can talk of technical institution, you can call of the management institution, you can call it as a pharma institution, you can technical institution, and whatever the institution you are taking. So whenever the money is coming, whenever the investment is coming, it is being utilized in creating infrastructure. Okay, they will be establishing various institute, like in our country we have IITs, we have IEMs are there, which are creating and which are fostering the talent. So government is investing in the human capital. We call that we are investing in human capital, right? we are sorry Yeah, we are investing in human capital. That means government is paying the fees. Government is paying and taking the charge of the people who are studying in this institute, so that once they are graduated, once they are out of the school, once they are out of the college, they will be the valuable resource to the country. Okay, whether it is related to technology, whether it is related to management, whether it is related to research. So whatever it is helpful in building the human capital. So again, investment is needed in all these areas. Then the fourth part is this is the fifth one. Foreign direct investment. The from the outside the country, a lot of international player wanted to invest in our country. You can see a lot of foreign brands, a lot of foreign companies are being in our country since 1991, since we have done the economic reforms and LPG reforms. So we have open liberalization, privatization, and globalization. We can see a lot of retail, e-commerce, telecom, and various big players are there. Okay, a lot of we have Amazon, Walmart, then various type of international companies, Hyundai, Honda. You just name the company and you will have an international player in our market, right? So again, these are the type of investments that are coming in our country, especially focusing on increasing the capacity building of our own country. Okay, so this is what the importance of investment. Now we will be talking about the classification of investment, like how we are classifying the investment. So there are two ways in which we normally try to classify the investment. First one is in the form of depth investment. Okay, here you are taking depth. Okay, debt means here you are giving your money as a loan, and the people are taking your money as a loan, and there is a period of payback. Okay, I am taking a loan for 15 years. After 15 years and 10% interest rate, you have to pay back my debt, right? So that is a debt investment. Okay, so here if you go by the debt instrument, so what are the public debt instrument that are available for all of you to buy is like government securities are there, then treasury bills are there. Okay, so these are based on they are being given on a discounted rate. Okay, they are given on a discounted rate. That means if it is of 1000 rupees value, they will give you at 900, and after maturity period you can encash it for 1000. Okay, so this is how these debt investment works. Okay, so person will get 100 rupees of profit in that, right? Then non-public private investment there is that. So there are non-public debt investments are also there, which are not openly traded. These are not openly traded. Okay, so the like if we go by one example, so there is an example of account receivables of a private company. Okay, so so what you can do is that like what any institution or what a financial company can do. So financial institution, they might purchase the account receivable of small businesses in India. Okay, so they take like they will be getting some account receivables in the accounts of a company. So this financial institution buys that account receivables and they provide immediate cash flow to that company. Okay, and while the financial institution earns the interest on the receivables. Okay, so this is yet another way through which the investment and money comes. Okay, then we have a equity investment, where you buy and sell the shares of a company, whether in the international stock exchange, whether in the Indian stock exchange. In India we have a Bombay stock exchange, we have a national stock exchange, then there are local stock exchanges are also there, where we are buying and selling the shares, like we are investing in the shares of companies, whatever companies, Reliance, Infosys, Tata, Wipro, then various other whatever companies you are talking about. Okay, so here buying and selling keeps on going through, right? Then we have a private equity investment are there. So again, these involved large scale investment. Okay, so there are private these are companies, these are very big institutional investors are there. Normally these are not open for public trading. These private equity investments are not open for public trading, so they are only for the high net worth individuals, or they may be very for institutional investors or high net worth individuals, right? So here a private equity firms will invest in a promising Indian startup. Okay, if you go and you invest in Ola, okay, you invest in Ola, you invest in Zomato, you invest in Swiggy, you invest in Paytm, you invest in PhonePe. Okay, so you provide the capital and then you take some ownership stakes on that. Okay, you take some ownership stakes on that, right? So these type of investment are not available for a small investor. That means you cannot buy simply 5-10 shares of that company. No, here percentage of the company is shared. Okay, 5% of the shares, okay, 10% of the shares. Okay, so this is again a huge lot of money is involved over here. So there are two type, debt investments are there, then equity investments are there. So under debt investment we have a public investment, then we have a non-public private investment, and under equity we have a public equity and private equity investments are there. Okay, now what are the factors that are affecting the investment in our country? Obviously the primary sector, people normally see how our primary sector is working, what is the role of our primary sector and how this is working, right? Agriculture and related activities related to agriculture are the main contributor to Indian economy. Okay, agriculture growth will provide growth to all the other sector, whether it's secondary, whether it's tertiary or various other type. Okay, because agriculture sector will feed on the raw material to the industrial products. Okay, this will influence the industrial production and corporate performance. So this is again, agriculture performance affects the investment in our country. Then again, rising national income boosts the consumer spending. More and more national income, more and more consumer spending, more and more demands, more and more GDP growth, and automatically more and more investment in that. Like now people wanted to buy shoes, people are having money, people are saying that we want branded shoes. Now people wanted to invest more and more, so again the shoe company will start making more and more branded shoes. Obviously that means the shoemaker will invest in their business, automatically there will be a capacity increase that will be happening. Then comes the inflation. Inflation is a very important issues in order to decide whether the investment will be coming to any country or not, because higher the inflation, it will reduce the consumer purchasing power, because you most of your money will be go on a we call it as a inflation, mehengai, right? So government has already set a target that we have to keep the inflation within the range of 2 to 6%, and most optimally the inflation has to be 4%. Okay, so last time because of the coronavirus, our inflation has already crossed the upper threshold, move over to 7% to 8%, and now it is lingering around, and slowly it is going below 6%. Okay, so in 2022 the inflation rate is 6.2%. So because of that, consumer are spending less, because maximum money they are, like if they are, if like 1 kg of onion is of earlier 60 rupees, now because of inflation the 1 kg of onion is of 120 rupees. That means extra 60 they are simply paying just because of inflation. There is no real worth of it, right? Then comes the interest rate. Interest rate also is a very important, or it is only the main factor which decides the investment decision in any country. Okay, so market interest rate influences investment decision. Lower rate encourages investment while higher rate discourages it. Okay, if RBI bank lowering interest rate to 4% in 2020, because of that it spurred the investment in real estate and infrastructure. Because how? If we have low interest rate, that means RBI is giving money at less cost. That means if you wanted to borrow 1 lakh from RBI, then earlier RBI was taking 6% from you. That means 1000, 1 lakh, 6000 rupees at the end of a period. Now RBI has reduced it to 4%. Now you only have to pay 1 lakh 4000. So now extra 2000 you will try to invest, right? So if RBI keeps their interest rate lower, so it spurred the investment. Okay, it will increase the growth rate. And if RBI increases their interest rate, automatically it reduces the investment in various other market. Okay, so interest rate is very important. And even the international players also looks for the interest rate in order to see where to invest in the market. Like if they are finding good interest rate in the country India, they will invest here. If they are finding good interest rate in US, they will be investing over there. Okay, then innovation and technical progress. So we know that technological advancement will always create opportunities, and because of that more and more investment, more and more R&D activities will be created. More and more R&D activities, more and more demand will be there for the capital goods, and automatically it will increase the investment in our own country, right? So if you go by understanding the technological advancement, you can see like how we are adopting to the digital payment system, and how this is spurring the investment in the financial technological sector. Now electrical vehicle. Okay, in electrical vehicle, government policy is like government is providing a lot of subsidies to it. Okay, so a lot of investment is coming in these areas. So this is how the investment is spurring in various other parts of the places. Okay, now we have a rapid population growth, we have a expanding market. That is why we need a lot of increased investment in all the areas wherever there is. Okay, we know that by 2021 Indian population growth will be 1.2%, and we have already crossed in 2023. We have already crossed, and we have become the most populous country in the world. I think last July we have become that. Okay, so we need a lot of healthcare products, we need a lot of housing products, we need a lot of consumer products, and we need a lot of educational products. So at every places we need investment. So these are the factors which are affecting the investment in this area. Now government taxation and government policy also affects the investment. If their government is taxing a lot of, if the government is doing a lot of taxation in various other places, so it reduces the investment in this area. Okay, if you are putting a lot of higher taxes, it reduces the profitability. Okay, and government, if government provided a lot of incentives, automatically it encourages the investment in all these areas, right? You know, government has reduced the corporation tax to 22%. So because of that, whatever the extra money that the corporations are having, they have not invested in various other places in order to boost the manufacturing activities, or also it has also boosted the infrastructure activities, right? So these are all things which are interrelated. Okay, now various investment model. Public investment model. in the public, the word public itself says that here government makes the investment for various type of goods and services, right? So from where this money is coming? So investment for revenue mainly come from the taxes. Okay, government take the taxes, and then government try to invest at various places in order to quickly fuel the productivity gap. During the COVID-19 pandemic in 2020, government came with mm, 20 lakh rupees package, Atmanirbhar Bharat package. From where this money is coming? Okay, this money is coming from the taxation, direct sector, indirect taxation. So government has invested heavily in order to boost the market, in order to start and rebound the market after the COVID-19 pandemic has started. Okay, so government wanted to quickly generate the demand. Government wanted to fuel the productivity. Government wanted to boost the human capital. Government wanted to encourage a technological revolution. So government is investing in the public investment models. Okay, so there can be a good amount of investment, there can be less investment. So whatever it is, okay, so investment will be provided by the government. Okay, now private investment models. Okay, so when there exists certain shortfall of earning in public sector, so government invites the private player to invest in some of its ventures. Okay, if the government thinks that we need some expertise, okay, government thinks we need expertise in certain area or some technological know-how in certain area, so government invites the private player in order to invest in these places. So here a private player investment can be domestic or foreign nature. Like you can get help from the private players of the country. You can take the investment from the from the foreign banks, multilateral banks or international banks or whatever it is. Okay, so you can have a foreign direct investment (FFIs). Okay, so they will be coming and investing in various type of infrastructure projects. They will be also helping in creating infrastructure. They will be investing in your productive sectors. They will be opening their industries over here. Okay, so this will help in generating the revenues, it will help in generating the employment, and obviously it will spur the growth, right? So this model is one of the most sought after it comes to external investment. Okay, so private investment, whenever we are getting private investment, it comes with more efficiency, because here we are getting more competition. It comes with competitive bidding. We have a greater flexibility in operation. Okay, so here we get more and more efficient way of working in the private investment models. Okay, now what is the issues in infrastructure financing in our country? What we feel like, why there are a lot of issues related to infrastructure financing in our country? Obviously there is a issue of funding gap. Okay, government don't have much resources, right? Even wherever we go, like especially we are focusing on the road sector. Okay, NHAI is there, National Highway Authority of India, so there is a lot of funding shortage is there. So they are extremely finding it difficult in order to create more and more expressway, more and more highways and roadways. So that is why there is a lot of issues related to the funding gap, and during the time of crisis it against the whole crisis becomes more and more exponential. Then a lot of fiscal burden is there. Even if the government is having a lot of money that government has to invest in various other places, like government has to provide money for education, government have to provide money for healthcare, and various other places are there. So it left with very less amount for infrastructure development of the country. Okay, so some of the maximum amount of money has been put to the Mahatma Gandhi National Rural Guarantee Scam. Okay, so there will be a very limited funding for the infrastructure that was there. Then asset liability mismatch of the commercial bank. Okay, so commercial bank have their short term liabilities are there. They do not provide long term financing for the infrastructure project. Okay, so banks are very hesitant in providing long term finances. Like in the power plant have a long gestation period, roadways are having long gestation period. Okay, commercial banks wanted to generate their money quickly, and the commercial bank wanted to put the money at the places where from where they can generate their money easily. Okay, so they are very very hesitant in providing long term loans. Then fourth one is investment obligation of insurance and pension fund. Okay, we know from insurance fund and from the pension fund. Okay, PFRD is there. Okay, PFRDA is there. We have LIC is there. Then pension fund is there. Then we EPFO is there. Then we have gratuity and everything. All funds are there. Pension funds are there. They are much more suitable for long term investment. Okay, because they have a very see here, the people are not taking out their money at a earlier time, so they are putting the money till the time they are getting retired. And for the insurance again, they are every time they are investing at the insurance in order to get secured, right? So are suitable for long term investment. Regulatory obligation limit their direct investment in infrastructure, but the problem is that LIC, PFRDA, they cannot simply direct whatever the money that is coming directly to the infrastructure of whatever it is. Okay, you cannot simply direct your full all money to be invested in infrastructure, because that is the people money. Okay, you cannot simply invest all the money at whatever the places you want. Okay, so EPFO, Employment Provident Fund Organization, has a restriction on investing a certain amount of fund on government securities rather on infrastructure projects. That means they wanted to put their money in secure bonds, okay, rather than infrastructure project. Okay, then we also need a very good, efficient and vibrant corporate bond market that we need, from where the government can generate the resources, from where the corporate also can generate the resources, because we need long term funding for road projects, for expressway, for railways, for various type of airport development, ports development, and various other big infrastructure projects are there. So they require lot of resources, lot of money, and that too of a long gestation period. Okay, so they that is why we need a very important that is why we need a very good vibrant corporate bond market. So we wanted to attract the investor in that place. Until and unless we create a good condition for the corporate bond market, we will not be able to attract that. Okay, and slowly government has even started developing municipal bond market. Okay, you know, Indore Municipal Development Board, then Mumbai Municipal Corporations are there. Now they are releasing municipal bond, because they are one of the richest municipal body of the country, and they have a good ratings. Okay, so they are releasing the bond for various type of infrastructure project in their own municipality, municipal area, and people are buying, which shows that people have a trust on these municipal bonds. So we need to develop the municipal bond by providing good rating agencies for various type of municipal areas. Then insufficiency of user charges. So many infrastructure services in India lack sufficient user charges. Okay, we are making lot of infrastructure, but because of regulatory issue, because of the political constraint, we are not able to properly charge the fees. Okay, you know, we are creating tolls on the state highways. Sometimes they are not even able to collect the tolls because of the political pressure and regulatory issues are there. So because of that, there is a very shortfall of the resources. Okay, but right now, because of the FASTag, now this thing has become more and more easier. Then legal and procedural issues are also there. So infrastructure development faces a lot of legal and procedural hurdles in our country. They require a lot of legal clearance. They require a lot of procedural requirements are there. A lot of environmental clearance they have to take. If we go by the example of Navi Mumbai International Airport or Bandra Kurla Sea Link is there, then we are going for any type of dams are there. They required a lot of. They face a lot of legal challenges. They face a lot of procedural changes. They faces a lot of environmental clearance. So there is a lot of issues related to infrastructure financing in our country. Now something that government, there are a lot of measures that our government has taken in this regard. Now, what are the measures that government has taken? Now, government has come up with a very important concept of public-private partnership. Okay, here the government is collaborating with the private entities, okay, where the resources are being shared, where the risk are being shared, where the responsibilities are being shared, and where the rewards are being shared between the government and the private parties. Okay, government has come up with one more important initiative, that is called viability gap funding. Viability gap funding means in 2026 government said that if there is a resource shortfall, then government can provide up to 20% of the total capital cost of that project. Okay, in order to jumpstart or to kickstart that product. Okay, so if that project is financially viable, okay, any project which is financially viable and it will in the future it will be generating revenues for the government will pitch in up to 20% of the total project cost. This is called viability gap funding. Then government have been started with FDI in infrastructure, so 100% FDI through automatic route, so there is no approval needed. Okay, whether it is related to mining sector, power sector, civil aviation sector, so FDI is allowed. 100% automatic FDI is allowed. Foreign capital, technology and expertise is allowed in all these sectors. In order to boost the activities in these area, you are attracting the foreign investment in all these areas. Okay, now there is a Indian Infrastructure Finance Company Limited is there, which is a central government company which is providing long term loans for, we have various projects, right? Road project is there, power sector project is there, then we have green energy projects are there, which are long gestation period projects are there, which takes 5 to 10 years to 15 years to get completed. So this India Infrastructure Finance Company Limited is there, which is providing long term loans to infrastructure project in our country. Okay, so so they are either directly to the project companies or refinancing the bank and financial institutions, so it can be done by any way. So it can directly provide money to the project companies, or it can refinance the bank and then bank can provide the money to that company. So this is a long term funding need which can be provided with the help of this infrastructure financial company. Then we have a infrastructure debt fund is there. So RBI and SEBI have issued guidelines for setting up of IDF. Okay, infrastructure debt funds are there. Focus is on to mobilize the fund from various sources for infrastructure projects. So they will be like the alternative avenue for the finances, right? Then we have a infrastructure bonds are there. Okay, so infrastructure bonds can be sold in the market. Okay, they can generate long term infrastructure bond for 10 years or 15 years bonds can be there. Okay, so this will encourage the investment in the infrastructure project, and because of these bond it will also help in providing the stable source of funding if we have any long gestation project. Then we can there is a concept that we can also utilize foreign exchange reserve. Okay, but this is a very very limited window that is allowed under that, in which the initiative, any initiative which is coming under a special purpose vehicle, that means the government thinks that this has to be done, so government can declare something as a special purpose vehicle, that this project is a special purpose vehicle, or this pipeline or this road is a special purpose vehicle. So there is a limited window through which the foreign exchange reserves can be also utilized for funding that project. Okay, so special purpose vehicle of IIFCL. Okay, so this will help in raising fund for infrastructure project without creating monetary impact domestically. Okay, then we have even we have also opened our economy, so now we can even borrow from the external commercial banks, multilateral bank or multi-finance banks are there. Asian Development Bank is there. Then we have a National Development Bank is there. Then AIIB Bank is there, right? Okay, we have Asian Development Bank is there, National New Development Bank is there. Then we have AIIB is there. We have a World Bank is there. We have various other institutions are there through which you can take, that is called external commercial borrowing. Okay, you will get at very reduced rate. Okay, so this will so government has even eased down the borrowing condition for that, and we ourselves has created our own sovereign wealth fund. Okay, that is called National Investment and Infrastructure Fund that we have created. This is the first sovereign wealth fund which wanted to attract the domestic and international investment. Okay, so there we will be having a corpus of money. Okay, we will be having a lump sum money which will be addressing various type of funding gaps that are there in the infrastructure project. Okay, so this will be like there will be third party investment, two party investment, whatever it is. So this will be investing, and this will be providing the necessary resources for various infrastructure needs. Okay, now we are coming into the public private partnership in the infrastructure in India. So what is the meaning of public private partnership? As the word said, public focuses on the government, private party, and both are participating, so they are sharing the responsibility related to resources, risk, responsibility, and reward related to any projects. Okay, so whenever we go by this, we have to find out some of the very important advantages related to this whole model. Obviously, since private party is involved over here, you are getting more and more efficient way of working, efficient way of delivery, efficient way of utilizing the resources and operation. Okay, and since private party is involved over here, you will be getting resources also for the working of the project, and since private party is involved, obviously you will be getting better technologies at the work. Okay, now we will see why what was the difference between the conventional projects and PPP. Okay, so here in the PPP projects, we have a unique project development strategy, implementation, and management process. Okay, it has a very important business model. Through particular business model and through a streamlined way of working, this PPP model works. Okay, here the concept of risk allocation, like who is bearing the risk. Construction risk, like we have various type of risks. Construction risk is there, we have revenue risk is there, we have a time risk is there, we have cost overrun risk is there. So what type of risk will be borne by which party? Private party will be bearing which risk, public party will be bearing which risk. Okay, so PPP contracts typically have longer tenure, and they keeps on like from 10 years to 15 years to 25 years, like that it goes on. Okay, now what exactly is the structure of public private partnership? Okay, so there is a very complex contractual arrangement is there between the various parties. So it is a very complex way through which this agreement is being done. Okay, normally whenever we are talking about the public private partnership, mostly all the public private partnership mostly works on the special purpose vehicle. Okay, so this is going to be a separate legal entity which will be undertaking a project. That means there will be a company which will be creating a special purpose vehicle, and that special purpose vehicle will be undertaking that project. Okay, and here a special purpose vehicle will be getting some concessionaire, okay, from the government. Okay, sometimes you will be having a joint ventures between the government. Okay, whether it is related to construction, whether it is related to resources, whether it is related to revenue sharing. Okay, so what is the role of government, how the government is going to involve in this PPP? The government will take its decision based on the strategic need of that project, financial viability, regulatory consideration. Okay, why government wanted to involve in the PPP project is that because government is the wanted to hold the strategic asset. Okay, it is not like that government is asking to make border road. Okay, and government has given that border route to a private player. Really, if some war happens or some troop movement have to take place, do we have to take permission from the private player? No. Correct. If we have to make a nuclear power plant, government takes control of everything. Government will provide a lot of resources, money and everything, but strategic control is taken by the government. Okay, then government also have to deal with political sensitivity and social obligation. Okay, government also have to check whether the project is commercially viable, and whether the lenders who are giving trying to provide the money have confidence in the project. And government also have to answer to the public. Government is answerable to the public, right? So this is all is the need reason for direct government involvement in the PPP project. Now we will see what is the significance of the PPP model. Now whenever we go by the PPP model, obviously there is a room for innovation. Quality and standard production will be happening, capital you will be getting, infrastructure, better infrastructure will be developed, delays, reduction in the delays and faster completion of the project feasibility is analyzed in the starting, then only the private person will come in. Okay, value for the money, skills transferation and better use of technologies and high return at the end. Okay, so you remember these points. Okay, remember these points, because these points will come handy whenever you are writing any answers regarding that. Okay, now there are certain limitation to the PPP model, because not all projects are feasible, because of there are certain political issues are there, there are a lot of some illegal issues are there, commercial viabilities are there. So private player normally back out from that places. Okay, sometimes private player do not show interest in these places. Okay, sometimes these PPP models are having higher cost unless more and more efficiencies can be created, so they may go on a higher costing side. Okay, and sometimes whenever there is a change in operation, when sometimes there is change in the management control, automatically there is a issue related to the working of the PPP model. Then regulatory efficiencies are also there. Okay, better regulatory efficiencies will create a better public private partnership model. Okay, if you have a very good regulatory efficiency, like if every project and everything is being monitored properly, proper regulations are being followed, automatically it will lead to the proper PPP model efficiencies. Okay, so there are a lot of models that are there under the PPP. First of all, if we go by the concept like who is owning the model, who is to whom the model will be transferred, who is going to take the responsibility of investment, who is going to take the risk, what is the duration. So there are like models include supply and management contracts are there, then Turkey contract are there, Turkey contracts are there, FMH lease is there, then private financing initiatives are there, then there are combinations of models are there which are working on build, operate, transfer. So build, operate, transfer are of various types are there. Okay, we will be understanding each and everything properly. Okay, so there are certain that is called supply management contracts. Okay, if we go by this supply management contract, in which turnkey contracts, FMH lease and private financing are there. So which here in the supply and management contracts, we have a private sector which is managing a part or a whole of public enterprise. Okay, while retaining the public ownership, the ownership will remain with the public or the government, but it will be managed by the private player. Okay, so they will be designing that, they will be operational, they will be providing labor management, they will be providing equipment. Okay, so they will be paid a fee, performance based. Okay, so why we are following this supply management contract? Because these are very quick and implementing in and they have a very they are very quick in implementation and simplicity. So we'll be seeing what is the meaning of turnkey model. Okay, it is like a in our Hindi we call it as thekedar. Okay, thekedar means I have given you a theka, I have given you a contract, you make this road at this rupees, I will be giving you this much of rupees. Okay, so design and build and give it back. Okay, so this is like a public sector model where private contractor are chosen, competitive bidding will be there. Okay, so there will be a tender, there will be tender that will be open, and whosoever win the tender will be start making that project. Okay, so that will be based on predetermined fees and predetermined cost. Okay, why focuses on this token procurement? This is the easiest way, this is the easiest way of working. Okay, because there is a familiarity with that process, there is a simplicity in the process, but issues are there related to that, because here there is no strong incentive for completion of the project ahead of schedule. Okay, like if you have a given 1 year to complete that project, and if you have completed in 8 months, but still you don't have any incentives, right? Or you don't have any motivation for early completion, or anything like that. Okay, so you have to bear the risk during the design and construction phase. Okay, and you have to, and the public sector will assume all other risk. Okay, during the construction and during the design, the contractor has to bear all the risk, and once it has been given, after that public sector has to bear all the risk. Okay, so normally in this project, investment is limited to both scale and duration. That means they are of a small scale, and the duration is also very very less, and they not, and in this there is no motivation and there is no incentive you get if you complete the project on time. So there is no incentive and no motivation there. Then we have a affirmage or lease agreement. Okay, so here operator who is a leaseholder has a responsibility of operating and maintaining certain infrastructure, okay, and services without making investment in that area. Okay, like in our country we go by that employed government of India has employed affirmage and lease model at various places, like Delhi International Airport Limited is there. Here was awarded lease agreement and operate and management development the Indira Gandhi International Airport. So Delhi International Airport Limited retains the revenue from airport operation, and they give lease fees to the Airport Authority of India. Okay, so this is like that. Delhi International Airport will get all the revenues, but they will just simply they will do certain investment at the airport, but they simply provide some lease fees to the Airport Authority of India. Why it is important, why we are focusing, why this is important, is that because swift implementation, okay, easy implementation, quicker development, operation is happening. Then private investment potential, there's a lot of private investment potential is there. Okay, because people wanted that something we should give at lease and we should develop it, we should generate the revenue out of it. Okay, like if we go by Mumbai Pune Expressway, private entity has made a substantial investment under the long-term lease agreement. Okay, then it has a good political and legal acceptance also. Okay, like in the port areas and airport areas, if you go, the Chennai Port Trust is there, which is again under the lease arrangement with which is politically supported. Okay, so this is the affirmage and lease agreement. But now there is a problem also. There are some of the limitations, or we call it as, right, limited private sector incentives. Okay, you do not get any good amount of incentive if you are operating very good or something like that. Okay, so if we see that sometimes we have a short-term leases are there, like toll road operations are there. Okay, here in toll road operation they are doing very little incentive, very little investment they are doing. Okay, they are just making that much investment which keeps that toll road running and toll naka running, right? Then public sector risk is also there. Okay, that means risk of investment is there. Okay, like Delhi Metro Rail Corporation lease agreement with the private operator, the government bore substantial financial risk. Okay, then focus on existing infrastructure. Okay, so affirmage and lease model normally utilizes or primarily utilizes the existing infrastructure. They do not create new infrastructure, they utilize the existing infrastructure. Okay, and they buy the old infrastructure, they just try to renovate a little bit of it, and they just work and try to generate revenue. Okay, so there is no that limits the applicability to the new development areas. Okay, then regulatory oversight. Okay, so it may require significant regulatory oversight to ensure that proper compliance and fairness is being given. That means whatever the minimum investment that has to be needed in this, whether you are making that or not, that has to be seen. Okay, like if we go by the container terminals are there at major port areas are there, that require a very robust regulatory oversight because a lot of safeguard issues are there. Okay, so regulatory oversight has to be done in the affirmage and lease agreement, because the private player will be doing very minimal investment, but we have to make sure that they should not compromise with any kind of regulatory issues. Now, what are the concession in public private partnerships that they are getting? Okay, now we will be seeing now we will be understanding under the public private partnership model, what is the PPP model. We have already discussed what government is providing and what are the various type of these PPP models are there. Okay, so here if we go by the public private partnership model, here government grants some specific rights to a private entity. Okay, concessions, right, to construct, to operate certain facility for a fixed time, while sometimes government retain the ownership and supply side rights with themselves. Okay, so here under the concession part in the PPP model, the payment is flowing from the both side. Okay, concessionaire pay for the rights, government may pay concession to meet certain conditions. Okay, so here the payment is coming from both the places, and normally this whole concept, the concession will be going for how many years, so it is going from 5 to 50 years or maybe more than that. Okay, so what is the pros of this concession that is being provided? Obviously there will be a risk sharing, so there will not be 100% risk on the government, or there will not be 100% risk on the private player. Okay, so this risk will be shared. Okay, then investment, so high level of private investment and high level of expertise. Okay, high level of expertise will be coming towards the government, and resources also will be coming. Then efficiencies and innovation, so there will be a good amount of efficiencies will be created, good amount of innovation will be created, technological innovations will be created. But under these concession, obviously sometimes there are certain limitations are there because of a complex nature. This whole process is a highly complex. Okay, so it requires a very good dealing with the private players. Then market suitability, what type of product, what type of model is suited for what type of project, that also has to be checked and tackled properly. Otherwise, if the wrong model is selected, it will be creating a chaos. Okay, then fiscal cost, fiscal cost, government has to bear a certain higher degree over here. So again, obviously it will be tax, it will be hurting the government purse. Okay, and time incentive, lot of negotiations has to go, lot of discussion, and lot of resources have to be wasted. Maybe that process can become lengthy, then we are able to get a contract and then project started. Okay, so we don't know whether we can start early, because we have to depend on like how the negotiations are going on, what are the discussions that are going on, right? Then regulatory oversight. Okay, so it requires a close regulatory supervision whether the private party is playing their proper roles or not. Okay, and then there are certain liabilities government faces in the medium term and the long term, because once the project is being delivered to the government, government has to maintain that project in the long run. Okay, now we are coming into the model, what type of models are there under PPP. Okay, so one of the model is BOT model. BOT is build operate transfer model. Okay, sorry, under the build operate transfer model, as the word said, you build it, you operate it, and then after that you transfer it. Okay, so under that build operate transfer, we have a build transfer operate, we have build rehabilitate operate transfer, when build lease transfers are there. Okay, so again there are certain differences are there. Okay, so here we are getting again concession. Okay, government is providing the private party is building, government the private party is operating that during the lease period, and after that, once the lease period is over, the private party is transferring that project to the government. Okay, so facility operate, or the government the private party operate that facility for a fixed period of time. Okay, so operational and investment risk are transferred to the concessionaire. Okay, we know Mumbai Pune expressway is there, where lot of private investment is being involved, so there is a transferring risk to the company. Okay, whether the highway will be running or not, whether the traffic will be there or not, that is all risk of the concessionary. Okay, then what is the government liability? Government has a contingent liability because of the loan guarantee and the defaults. Okay, if we go by the example, so there is a Karnataka government which is facing a lot of liabilities regarding the Hubli and Dharwad water supply project. Okay, because here the private contractor has defaulted on the loans. Okay, here the private party and here the private contractor has defaulted on their loans. So here that is why government has to face the liabilities in the Hubli and Dharwad region. Okay, then government control and support. Right, then government control and support. So here government retain the ownership, okay, to control the policy, right? So here NHAI provides support to the BOT highway project in India, build, operate and transfer, right? You can toll, operate the toll, and then you can, after that you transfer it, right? So here revenue generation, government focuses like concessionaire revenue comes from the managing user facility, okay? Like, you know, toll revenue of the Yamuna expressway on Uttar Pradesh is done by the JP. JP Group has created that, and they are working on the build, operate, transfer. They will be generating revenue for certain concession period. After that, that will be transferred to the government. Okay, then structural concession, like based on the maximum revenue share or minimum concession period. Okay, Gujarat Gift City is there, where a fixed concession period and revenue sharing agreement has been signed between the government and the private player. Okay, so there are certain risk that are also associated with. So there are political risk. Okay, government can change their policy. This may affect the power project, like Mudra Ultra Mega Power project is there. Then sometimes technical risk are there. Okay, sometimes we have a delay in construction because certain disaster has happened. Okay, you know, certain, like in Konkan railways, all of a sudden there is a landslide that has happened. Okay, so this all create a issue. So this is a technical risk. Then financial risk are there. All of a sudden there is a foreign exchange risk is there. All of a sudden there is a the interest rate has gone very high. Okay, you know that Mumbai Trans Harbour link is there, which is again impacting the cost because of the foreign exchange rate, and because of that it has impacted the cost, and it has the cost has been increased manifold. Okay, so this BOT model obviously provide a lot of framework for the private investment, where the risk is being shared between the central government and the private players. Okay, so it has both success and challenges, but it depends on like who wanted to take what type of risk in this whole process. Then we have a BOOT, build, own, operate and transfer. Okay, so here the burden, we are easing the burden on government. We have a Delhi Metro Rail Corporation phase 2 project is there, which is will build on the BOOT model. Okay, here we are focusing on like a build, you own it, you operate it and you transfer it. That means you also own that project for certain degree of time, that will be yours. Okay, so here we are attracting the foreign capital into the infrastructure segment. Even Mumbai Pune expressway is there, that is working. Okay, transfer of technologies will be happening because we will be getting a lot of access to our technologies and expertise from various part of the world. We have a Mudra Ultra Mega Power plant is there. Okay, where we are getting a lot of new technologies from the various part, like under the BOT model, under the Ultra Mega Power project, we are getting the technology from the General Electric company, which is based in the USA. And under the BOOT model, which will be completed in a stipulated time frame and planned budget. Okay, you know, Gift City is there again. So there is a very little difference between BOOT and BOT model. Okay, so BOOT project reduces the financial burden on the public budget for infrastructure development. Here more and more private involvement is there. More and more private involvement is there. Like if we go for the Chennai Outer Ring Road project is there. Okay, so this is again getting a lot of money from the private sector, and which is a project of the public welfare, and but the more and more finances will be coming from the private player. Okay, then build, own, operate. Here ownership typically remains with the project company. Okay, here it will not be transferred to anywhere. Okay, whosoever is building, they will be only owning, they will be only operating. Like solar power plant is there. Okay, they will be building, they will be owning, and they will be only operating. There will be concession that will be provided for a lifespan. So here you get some like a preferred physical life of the project aligned with the concession period. Government provide lot of concession for the working, like if you are setting up of 2 megawatt of solar power plant, so government will provide 10 to 25% of the subsidy at that period, okay, like that. Okay, so financial investment and payback period. So like first of all, we'll see what is the example of that. So if any private firm construct and operate a toll road under a concession agreement with the government, so they maintain the ownership until the end of the concession period. That means the ownership remain with that private party. Okay, in that period government cannot say anything to that party. Okay, in other places government can dictate the terms, but here government cannot do. Okay, so here a lot of financial investment is needed, and they have a long payback period. Okay, because the nature of infrastructure, if toll road is there, you may get in 10 years, you may get in 15 years, you will be able to generate your revenue. Okay, so like we have already studied the example, like it happens with the energy sector, transportation sector, water management facility, private sector, any sectors are there in which are working on the build, own, operate. Here they are building there, they are owning it, they are operating. Okay, so here build, own, operate is similar to BOOT, except private entities solely own the project without any obligation to transfer it to the government. Okay, so long-term revenue you can generate. Okay, private sector participation you can get, and efficient project operation can be also done. Innovation and technologies, and reduces of the financial burden of the government. But limitations are also there, government will lose the control over the like infrastructure asset. Okay, private sector may monopolize that area. Regulatory changes may not be that much hard on these, right? And you may not get equitable access to the essential service, because if it is controlled by the private party will not may allow or may not allow that area. Okay, then complexity and renegotiation of the contract is also a very big issue. Okay, so build, own, operate, like if you go by the example, if you go by that, it is Mudra Port in Gujarat, which is totally under the Adani, which is being totally run by the Adani Port and Trust. So this is one of the best example, which is of build, own, and operate. Then we have a BLT model, built, lease, and transfer. So under the BLT model, the private entity builds the infrastructure, then lease it to the government, and eventually transfer ownership after the lease period. Lease means you will make a project, this project has been made, you lease it to the government, government will provide the certain revenue for the operation of that area, and once the lease period is over, and once the government will provide certain category of money to you. Okay, so here government will get access to the infrastructure. Here government don't have to do immediate capital expenditure. Here's private party has already done that, and private party has transferred that project to you on the lease. Okay, every year you will be paying certain amount to that private party, and after the lease period is over, the whole ownership will be transferred to the government. Okay, so private party will be getting steady income. Okay, and it will also help in transferring of the ownership to the government after a period. Okay, it will reduce the burden on the government, and even it will reduce the burden on the private party. Okay, so this will encourage private sector participation, but risks are there. So lease payment becomes sometime unsustainable. Sometimes government is giving on time, sometimes government is not giving on time. Okay, sometimes the lease terms are unacceptable, and sometimes they are very, very compromising. Okay, there are a lot of complexity that is there under the negotiation lease. Lot of disputes gets over the asset valuation, like what is the asset, how much valuation is there, how much it is going to be the lease amount. So there is a lot of issues that happen between like calculating the lease amount. Okay, then limited government control over the vital infrastructure during the lease period, because during the lease period the government is not owning the project. The project is still under the hand of the private party. It is only after the lease period that will be going. Okay, so we have example of Mumbai Pune Expressway under this category. Then we have a DBFO model, design, build, finance, and operate. Okay, so here you are, the private party is designing, private party is building, private party is financing, and private party is operating this whole model. So under this model, the private entity will design, private entity will build, will finance, will operate the infrastructure project for a specific period. Okay, so all the construction risk, operation risk is borne by the private player. Okay, so because of that, here everything has to be done by the private player. It will accelerate the project implementation. Okay, we will get, obviously we'll get better efficiencies over here, and it will also generate long-term revenue because there is a specified period for which that has to be done. Okay, so government will be having less financial burden and will encourage the innovation and technologies. Okay, so but there are certain limitations are there, because there is a risk of private entity prioritizing short term profit over the long term sustainability. Okay, so private party may focus on certain shorter routes, certain shorter projects, okay, instead of focusing on long term development of the country, right? So here all the things has to be done by the private, has to be designed, build, finance and everything. So they may focus on the shorter profit than long term sustainability. Then complexity in negotiation, financing terms and managing the financial risk. So there will be a dispute over the design and construction quality, which again poses a very big limitation under that. Then challenges in accurately estimating future revenue streams and demands. Then limited government control over the project, because during the operation and concession period, right? So entire responsibility is of the private party. If we have a Delhi Metro Rail Corporation India Limited, it comes under the DBFO model. Then DBOT, design, build, operate and transfer. It is again similar to DBFO, but here the distinction is that ownership is transferred to the government after the concession period. Okay, here the transfer construction, operation, financial risk or remains with the private sector. Okay, so project implementation will be accelerating and private sector efficiency will be getting. Okay, so they will be generating a lot of profit from here in the during the concession period, and financial burden of the government will reduce. Okay, and it will also transfer the ownership to the government. There are limitations are there, like short term profit over the long term, similar to the DGFO. Okay, DBFO model. Then accurately estimating the future revenue, that is again one of the hardest thing to accurately find out, like what is going to be the revenue in the future. Then limited government control over the project during the concession period, and there may be issue regarding the dispute over the asset valuation. So here examples from India's Chennai Outer Ring Road, which is working on DBOT, design, build, operate, transfer model. Okay, now then we have a design, construct, manage and finance model. Okay, DCMF. Here private entity is responsible for entire project lifestyle, including design, construction, management and financing. Okay, so here all the risk are being transferred to the private party. Again, project implementation will be improved, sector efficiency will be improving, private investor will be coming because long-term revenue streams will be coming. Okay, financial burden will be reduced of the government, and innovation and technologies, right? So again here also you can see a lot of like most of the points are similar to that, but only the thing is that here all the responsibility for the entire project life cycle, okay, till the project is there, this will be under that private party. Okay, now what are the contemporary development that has happened in this whole field? Now you see there is a Swiss challenge model that has come. Okay, Swiss challenge model in public procurement. Okay, so what is the meaning of that? Under the Swiss challenge model, here we are fostering the competitive bidding and counter bidding. That means I am bidding, I am putting a bid number 1, another part is putting bid number 2. So now there is a competition between the bidding and counter bidding, so that we can come to find out the actual optimal cost and efficiency of that project. Okay, so if we go by like what is the example in India, so we have adopted a Swiss model challenge in renovating 23 railway station in 2017. Okay, we have contacted the contractors, they have come up, they have put a bid, like they will be renovating this and that part, and then we have a counter bid coming from there. So this process increases the transparency. Okay, bidding and counter bidding open the challenge, enhancing the accountability. We have a Jaipur Development Authority that has also utilized a Swiss development challenge in mega film city venture. Okay, then creativity. Okay, under this Swiss challenge model, you can also be creative in providing a more and more better design, more and more innovative solution. It is not like that a bid one only regarding the money. No, you can also try to provide new design, you can also provide new innovative solution. Okay, so here, if we go, like we have discussed regarding a mega film city venture in Jaipur, which are creating unique and creative design concepts. So here again, bidding and cross bidding and counter bidding are happening in order to find out like who is trying to create a much more better place and much more better design under that. So this is a Swiss challenge model of bidding and counter bidding. So but there are certain concerns related with the Swiss challenge model, like it may lead to the information imbalance. Okay, sometimes we do not be able to get fair treatment of bidders. Okay, sometimes it may lead to corruption. Okay, then opponent bidder might submit counter proposal to create confusion. Okay, they may just try to create confusion in order to reduce that other bidder outside the process. Then that is why we need a strong legal and regulatory framework and proper direct negotiation on the table with the private player should happen in order to understand this whole process of working. Okay, so why we are focusing on preference for competitive bidding? Because it offers the best value. Okay, best public private partnership project, and in that way government will be also having a optimum use of resource and significant concessions you will be getting, and you will be also able to generate a social and economic benefit. Okay, but in India we have a lack of legal framework regarding this. Okay, so that is why it may face challenges in running the Swiss challenge model. Okay, and sometimes we are thinking that smaller, let's focus on smaller models and then we are putting into the bigger models. Okay, it should go by smaller projects and then more and more suitable projects will be working under that. And so here this Swiss challenge model is ideal for the places which requires a lot of creativity, where a lot of design is involved, where a lot of innovation is involved. So that is why 2-3 players can fight for that project. Okay, where a lot of creativity, a lot of design, a lot of innovation is involved. Okay, then we have a EPC model: engineering, procurement and construction and PPP. So there is a comparative analysis that has to be done between these two models. Now sometimes we do a comparison between two different models. Okay, so there is a PPP model, public private partnership model, and then engineering, procurement and construction model. Okay, so what is this EPC model? EPC model stands for engineering, procurement and construction. Here contractor are legally bound to complete the project within a fixed time frame. Government will pay the entire project cost, including land acquisition and regulatory clearance. You will get all the clearances, but you have to do all the engineering activity, you have to do all the procurement activity, you have to do all the construction activity. Money will be provided by the government. Okay, so government raise the capital through like NHAI bonds and various other post-construction bond and various banks and various type of resources government is taking out. Okay, so here the risk of the project is completion lies primarily with the contractor. Here the contractor completion of the project risk is lying with the contractor and resources are being lying with the government. Okay, so the development, operation and maintenance of the wayside amenities along with the national highway are executed by the EPC model. Okay, now EPC versus PPP. So what exactly are the advantages of engineering, procurement and construction over the PPP. So here it is government funded, obviously that is a very important thing. Here the government is funding the whole project. Then reduce risk for the private player. Here the private player only has to focus on providing engineering activities, procurement activity and construction. They don't have to worry about the clearances, land acquisition, risk and various other things. They just have to work over there. Okay, then increased incentive. So with reduced risk and fixed profit margin, that means you will have a fixed profit margin, that you know that you will be able to complete this project at this much price. So you have a incentives for completing the project on proper time. Okay, then streamlined construction timeline. Now you have a resources, you have all the regulatory clearness, you have all the timelines and everything is there. Okay, so here you have a provision of penalizing delay. Okay, if you are delaying, then you will be penalized by the government. Okay, so government hold EPC contractor accountable for the entire project. Okay, so here the blame game is reduced. Okay, earlier in PPP model there is a lot of blame game. Okay, so they keep on putting on private sector, they are putting on private play in the public sector, but here the blame game is totally dependent on in the private sector. Okay, only on the contractor. Okay, so here government decision to develop wayside amenities through EPC model showcases accountability and streamline this whole operate. But there are certain challenges related to EPC model, because since government is providing all the resources, so again there is a lot of financial burden that government has today. But under the PPP model, here the finances comes from the private party also, right? So here government is focusing and government is bearing all the burden of the resources and finances. Okay, and lack of incentive for cost reduction, like if any private player is reducing the cost, so there is no incentive that is being provided. Okay, so because they will be only receiving certain fixed amount, even whatever innovation, whatever cost reduction they will be doing. Okay, so if we go by the example, so there are a lot of during a period of reduced private sector participation in 2013, 14 and 14 and 15, Indian government has increasingly turned to EPC, because there are a lot of PPP projects were there which got stalled because of investments. So government have turned on to EPC model. Okay, so EPC model will reduce the risk, EPC model will streamline all the process. EPC model, government will provide all the finances. Here the risk factor is also being properly channelized. Okay, so here the private contractor knows their duty, the government has known their duty, and this is called as much more efficient way of working than PPP model. Okay, then government has came up after a certain period of time with hybrid annuity model. Now under the hybrid annuity model, here government has combined the elements of EPC and BOT model. Okay, you should know, like there is a combination of BOT model. Okay, hybrid annuity model combines is equal to EPC plus BOT model. Okay, so fixed and assured payment the private player will be getting. Okay, so here under the hybrid annuity model, the government is providing assured return, guaranteed payment from the government. Okay, so here the private party don't have to depend on the traffic, like if we go by the toll connection. Okay, toll collection, otherwise they have to depend on the toll collection, like if 25 years is there, so till 25 years whatever toll is there you can collect it. But if there is no traffic, then what will happen? So here government has given guarantee that every year you will be getting certain annuity. Annuity means certain payment you will be getting from the government. Okay, so here government provide all the 90% land acquisition and various clearances are being provided by the government, and concessions are handled 60% of the operation maintenance cost, right? And here hybrid model is being put. Only 60% financial required upfront with 40% available during the construction. Okay, so this is what the government is there. So government will provide 40% grant so because this will be reducing the burden on the private player, and private player will be start working on that whole model, and government will be providing annualized annuity to the private player in order to generate their own profitability. Okay, so this is a hybrid annuity model. Okay, so under the hybrid annuity model, government, here if I say, 1 minute, government provide 40% of the costing in the first 5 year. First 5 year government provide that costing, and for the first 5 years government provide annual annual annuity payment, right? And remaining payment will be coming based on the construction, and based on the asset created and the performance of the developer, right? So this is how the annuity model will be working. Okay, so it prevents the private player from risk of revenue, because here government is guaranteeing annuity for the concession period to the private player. Okay, so why there is a need of that model? Because there is a burden on developer with finance, operation and revenue risk. Because of that, there is a they get discouraged in participation. So here government has taken their financial risk on themselves, operational risk also, and revenue risk on themselves. So government said that you start building, we will be take care of your financial need, we will take care of your operational and revenue needs. Okay, so funding challenges have been ensured in a transparent and time bound decision, but there are certain challenges that are there in hybrid annuity model. Okay, because still it is in the testing phase. Okay, so we need more and more participation in this area. Okay, we need more and more old contractor, we wanted more and more people should come there. So there should be a confidence building measure also should be there, that has to be built among all these people. Okay, so this is hybrid annuity model. Now we are coming into the general, what are the challenges faced by the private builder in the PPP projects. Obviously challenges faced are delay in land acquisition and institutional clearances, because these are one of the most important things which has to be tackled, because until and unless you have proper land, until and unless you don't have proper clearances, you cannot start your work. Okay, if you have a lot of delays in all these clearances and land acquisition, obviously the project costing will increase automatically, the interest rate will increase. So these are the first challenges that are being faced by the private builders in the PPP project. Then capital raising challenge, like how to raise the money. Okay, because these are high costing, high capital intensive sector, capital intensive sector, they require lot of money. Okay, so because of that, sometimes private player run out of money. Okay, so because of that, project becomes NPA, non-performing asset. Okay, so because of that, they become blacklisted. So because of that, bank do not lend another loans to these private builders. So there is a need for finding out the proper balance between the capital requirement and who will be providing what type of capital and how. Okay, so that is means a difficulty in fundraising and investment, because we are the developer is not able to properly attract the investor, because there are a lot of issues related to regulatory clearances, lot of papers work, and lot of land acquisitions are there, and then forest department, defense authorities, various other things are there. Because of that, project gets delayed. Because of that, the private party, the banks are not able to provide proper funding. Then traffic assessment and road designing challenges are there. Now when we talk about the traffic assessment, like if we are designing a road, okay, that is a specific example. Now road has to be constructed from one place to the other place. Now we are putting a toll booth over here. So toll will only operate when we have a traffic here, right? Until and unless we don't have a traffic, how you are going to generate the revenue? Okay, so that is again one of the most challenges regarding the traffic assessment and road designing challenges are there. Okay, so how you can properly accurately assess the traffic flow, how you can design a road, like how we can properly assess whether whatever we are investing here, whether we will be able to generate that much of revenue from this whole road. Okay, so again, this is again a issue with the private builder. Okay, so now, what are the way forward in PPP projects in India? Like what we can do. So first of all, whenever we talk about the way forward in the PPP projects, we are looking forward like how we can balance the risk allocation. How we can balance the risk allocation, like how we can improve the fair distribution of risk so that nobody should feel cheated, like how we can distribute the risk between public and private entities. Okay, so there should be totally clear out stand alone responsibility are there, clear out. Okay, there should be no confusion between like what type of risk is going to be beared by who. Okay, so there should be a clear cut responsibility for each party has to be outlined. Okay, and second one is flexibility in contract. Okay, so contract should allow flexibility to withdraw and rebid the project, because we don't know, because since they are the long gestation projects are there, we don't know what situation come, may government changes, may interest rate changes, may foreign exchange changes, may foreign exchange rate may changes. Okay, so there should be a point of flexibility to withdraw and rebid the project if there is any underperformance or any thing which is not being discussed in a contract properly, if comes like that, so there should be a flexibility to withdraw or rebid. Okay, so if any private builder failed to meet the project milestone or quality standard, okay, so the government may try to terminate the agreement, and there should be a alternative solutions for that. Then central capacity building, government itself should build their own central capacity. They should have they should create a capacity to assist various ministries. They should take assistance from various authorities, state structure, and how they can renegotiate, and they should come out with a model PPP which is applicable throughout the country, where we will be having all the listed issues, all the listed things should be there. Okay, so everything will be dealt over here only. So we should have a model PPP contract that should come out. Okay, so we should have a dedicated agency, we should have a dedicated department to provide guidance in project related to PPP and contract negotiation. Okay, so this is related to the PPP projects in India. Now we are coming towards the significance of foreign investment in developing country. Okay, we know that we are in dire need of foreign investment in our country, because we are not able to generate. Every year we have a deficit, budget, so we are not able to fulfill our infrastructure need by our own revenue sources. Okay, so always we are often fall short of supporting large scale infrastructure project, whatever it is, maybe highway, power plant, bullet trains, or whatever it is. Okay, so there has to be a funding that has to be provided so that it can bridge the funding gap which can drive the economic growth of our country. Okay, then balancing payment deficit. Okay, so we have a lot of balance of payment deficit, sometimes usually comes regarding import and export are there. Okay, so foreign investment helps us in bridging these deficit. Okay, and this will help us in stabilizing our external financial position. Okay, then mobilizing of the fund through taxation. We know that we are getting good amount of taxation, and taxing the foreign enterprises that are operating in India and generating revenue from government coffers. We can also try to put certain taxation on him, like if you are working in India, then certain degree of your profit should go to education, healthcare, and infrastructure. Right now government has come up with the corporate social responsibility under the Companies Act of 2013, where CSR fund is being created, where all the companies have to provide their net 2% of their net profit in all these activities. Then employment generation, foreign direct investment comes in the manufacturing and service sector. They create huge lot of jobs in our country, and they provide lot of qualitative jobs to our Indian workforce. And as you all know that we have a lot of multinational companies are there. We have various companies like Infosys is there, Wipro is there, Tata is there, we have Deloitte is there, Microsoft, Google. Lot of multinational companies are there which are employing Indian local workforce, and that because of that overall workforce employment growth is happening. Okay, and foreign investment also help in fostering skills and technological advancement, because they not only bring the capital but they also bring their expertise in management, they bring their expertise in entrepreneurship, they bring their expertise in technologies and skill development. It is not like that we are not sending something to them, but we are getting also, and we are also sending our own expertise to those places. We are taking their expertises to our places. If you see, like a lot of our firms are there who are being run on various management models are there. We have a lot of management models, we have motivation model, we have organizational models are there, right? So these are all being created outside our country, and we are enhancing, we are adopting certain models in our country, right? So they are bringing skills, they are bringing technological advancement to our country, and obviously overall competitive advantage we are getting, and overall competitiveness we are generating of our own work. Okay, now what are how many types of foreign investments are there in our country? Okay, so we have a two important type, like one is the direct investment, and then we have a portfolio investment. Okay, under the foreign investment we are either in the direct investment we are wholly owned subsidiary, we are coming like that, or in the form of a joint venture, or in a form of acquisition we are acquiring certain, or we are joint venturing with somebody, or wholly owned subsidiary. That means we have a subsidiary and we are investing in that. And then we have a portfolio investment, where FFIs are investing in our market, like foreign direct receipt and global depository receipts, and financial commercial borrowings are there. Okay, then treasury bills are there, then we have a government securities are there, then these are being invested by the FFIs. The FSIs invest in our market, and then whenever because this is a highly volatile, FSIs are highly volatile, and rest these are the stable investment. Okay, so normally in this category we call them as FDI if that is more than 10% of the cost, and if it is less than 10% we are going as a FI. This is volatile, this is less volatile or stable investment, right? So foreign direct investment may be in the form of a greenfield. Greenfield means we are making everything from scratch. Okay, from the scratch. Okay, new facility or expansion in new country or at new places. Okay, we have a lot of multinational companies are there. We have a Coca-Cola, we have or we have Microsoft is there, we have Google is there, Facebook is there, we have a lot of like big multinational fast moving consumer goods companies are there, which are creating they are buying the land and they are creating their old factories and everything over there. Okay, or the second way is a merger and acquisition. Okay, merger and acquisition, like you try to transfer the local firm to the foreign entities, like like how the Walmart has taken over the Flipkart. Okay, I think that was a $17 billion deal or whatever it is, I don't know regarding that. Okay, so this is a like a merger and acquisition that has happened, right? So why we normally prefer FDI over FFIs? Okay, why we prefer foreign direct investment over FFIs? Okay, FFIs. Okay, that is the main concept, that is the main thing that we wanted to ask. Okay, so FDI never creates debt obligation because we are not taking loan, it is just the investment that is coming. Okay, that is a company they are creating over here, they are investing, they are putting everything over here. So is FDI brings in capital without increase in the debt level. Okay, so like if any company, like here we have given an example, like if Suzuki is coming, Japanese company is invested in Maruti Suzuki. Okay, they are coming with their own capital. Okay, they are not creating debt. to our Indian market, because we are not taking loan from them. They are coming, they are investing their money in Indian market just to increase their own market. Okay, obviously when they are increasing their market, automatically our jobs will get created, our market will increase, our economy will increase, our GDP will increase, right? Then reliance on quick reversal. So FDI is less susceptible to sudden reversal. It is not like that you can suddenly take out your money and go back, okay, in the FDI. No, it is not a short term capital. You know, short term capital is FFI. FDI is long term capital. FDI is a long term capital. Okay, so this is how, like, if Hyundai is coming, if Samsung is coming, they are investing in India. They are bringing their capital to India. They are coming as a FDI with a lot of investment to their country, because they will be generating their products and then they will be selling throughout the world. Okay, so FDI is highly stable than FFI. Okay, that is what we want. Now, what are the categories of FDI? How many, like how we categorize the FDI? So there are three categories. Category one is like sector wise. There are certain sector in which 100% FDI is permitted through automatic route. Automatic route means here, like an investor or an Indian company does not require, or non-resident investor do not require any approval from the government for their investment. They just come, they take necessary clearances and they start investing. Okay. Then there is another in which 100% FDI is permitted, but through government route. That means you have to first take the government permission. Government will verify from where you are, from which location of the world you are, what is your financials, what is your financial result earlier, what is your intention behind investing in India. Then, because these are some sensitive sector, these are some sensitive sectors are there in which government requires certain degree of scrutiny. Okay, so here prior investment you need government approval which is required. Okay, so under government route are considered respectively administrative, like if something is there, if you wanted to send it to the defense, okay, so you have to send your proposal to defense ministry, then defense ministry will scrutinize your proposal, then they will allow you how much investment you can do in our country. Then we have a category 3 in which 100% is permitted, here certain government and automatic route. Certain part is automatic, like up to 49% you can automatic route you can do it, but after 49% you need government approval. So that is the another category of FDI that you are needing. Okay, so some of the prohibited sectors are there in our country where there is no FDI allowed. So what are these sectors which are prohibited? So lottery business is there, like government or private lottery. So this is prohibited. There is no FDI allowed under that. Then chit fund, there is no FDI allowed. Trade and transfer development right, there is no FDI allowed. Manufacturing of cigar, chirot, cigarillos, cigarettes, tobacco, under that there is no FDI allowed. Okay, then gambling and betting including casino, no FDI allowed. Nidhi companies, no FDI allowed. Real estate business or construction of farmhouses, no FDI is normally a certain degree of so there is star is there, so you need government approval is there. Then sector not open to private sector investment, atomic energy, railway operation and other are there which under which FDI is not allowed. So these are the prohibited sectors. But now what is the process, like how you can fill for the approval? Now whenever you wanted to apply and whenever you wanted to invest in our country, okay, for foreign investment, so along with the supporting documents you have to go to the portal that is called www.fifp.gov.in. okay, so there is an internal process then start. Okay, DPIIT, Department of Promotion of Industry and Internal Trade, will identify the concerned ministry and then send your proposal to the concerned ministry, okay, within 2 days. Okay, so once they have received their proposal, the same will be circulated online to the RBI within 2 days for the comment from the FEMA perspective, or okay, Foreign Exchange Management Act perspective. right? So it will go to the ministry, concerned ministry, and it will go to RBI regarding FEMAC. Okay, and if there is any proposed investment that is coming from Pakistan and Bangladesh, so this will also be requiring the clearances from Ministry of Home Affairs. Okay, then DPIIT will be required to provide its comment within 4 weeks from the receipt of the online application. Okay, and Ministry of Home Affairs, if applicable, to provide comment within the 6 week. Okay, so after all these things, additional information and clarification may be asked from the applicant. Okay, so within this whole process, there is certain other clarification may be also asked from the applicant, and that clarification has to provide within the week's time. Okay, then proposal involving FDI exceeding approximately $775 million has to be placed before the Cabinet Committee of Economic Affairs. Okay, then after that, once the proposal is complete in all respect, the same gets approved within 8 to 10 weeks. Okay, so like from 4 weeks to 8, so 12 to 14 weeks proposal is there, under which this whole process has to be approved. Okay, if you are providing like all the necessary and proper information. Now there is a 100% club that is also there, like where 100% foreign investment was already permitted. Okay, like agriculture and animal husbandry, under that we have we have done the subcategories are there. Then we have a mining sector, coal, lignite, precious ore, coal processing, titanium. Then pharmaceuticals, aviation sector, media sector, petroleum, construction development, satellites, financial service, and telecom sector. These are there which are like evergreen 100% FDI getter over there. Okay, then some newly opened business like defense have been recently opened, trading has recently been opened. Okay, like e-commerce, cash on carry, wholesale, right? You can see Amazon's is there, Flipkart, Amazon is there, Walmart is there, and everything is there, right? Then railway infrastructure, where 100% FDI they are putting. Then further FDI liberalization in pharma, then aviation and various, so further liberalization is being allowed under, because under aviation there are only certain category where you require 100% FDI, but now government is also looking for certain further liberalization in all these sectors. Okay, now what is the statistics that is being part of it? Okay, so since the liberalization, so there is a significant improvement happened in the field of FDI and foreign investment. Okay, so India has joined the top 100 companies on the ease of doing business and attracting of the foreign investors, right? So because India has done like make in India, then ease of doing business, then providing substantial support and reducing the time frame in getting the clearances and everything, right? So over the last 23 years till December 2023, we got around 971.521 billion of FDI. Okay, and if we go by the Narendra Modi government since 2014 to 2023, FDI reached 448.869 billion. That means 67% of the total FDI that has come from the last 23 comes from these 9 years of the Narendra Modi government. Okay, so from 45.15 billion in 2014-15, it has recorded 83.57 billion in financial year 21-2022. Okay, in 23-24, this is estimated to 17.96 billion, and with FDI equity flow of 11.50. Okay, top countries from where the which are contributing to the FDI flow is Mauritius, Singapore, USA, Netherlands, and Japan. These are the top 5 countries. Okay, where Mauritius is having 26% FDI flow is coming from the Mauritius. Okay, and which sectors are attracting this FDI is, first of all, obviously this is a service sector, computer, software, hardware, then trading, telecom, automotive industries. These are the top sectors which are getting the top attraction of the FDI in our country. Okay, like finance, banking, insurance. You can see like a lot of startups lot of startups are coming in these areas because of the FDI that is coming in these areas. Okay, and which states are receiving the highest? So Maharashtra, Karnataka, Gujarat, Delhi, and Tamil Nadu. These are the industrial states of our country, are the top most 5 states which are attracting the highest FDI. Okay, especially Maharashtra is getting 30% of the FDI inflow, and after that 22% is being getting uh, by the Karnataka. Now there is a change that has been given to the FDI in the space sector. So FDI amendment that has been done in the space sector is that we wanted to liberalize the provision in the space sector. We wanted private entity should enter in the satellite launch vehicle systems. Okay, they can create space sports for launching and receiving spacecraft and manufacturing facilities. So now under the amended FDI, 100% FDI is allowed in the space sector. Okay, so there is a liberalized entry which we wanted to focus. So you can see last year we have first of all launched the private launch vehicle we have launched, right, last year. So there are a lot of private startups that are coming in order in the launching sector, in the satellite sector. Okay, so up to 74% automatic FDI is allowed under the satellite manufacturing operation and satellite data products and ground segment and user segment, and up to 49% in the launch vehicle and associated system. Why we are putting up to 14%? Because this launching can be also utilized for missile purposes. So that is why government wanted to keep control over this area. Then up to 100% in the manufacturing of various components or substance of the satellite and ground segments of the satellite. Okay, so this is all being part of the Atmanirbhar Bharat Make in India initiative, where government is wanted to link its space program. India is having the top 5 countries in the space programming. India having its own space program, and India is spacing, and India is also providing a lot of laurels like Mangalyaan mission, Chandrayaan mission, and everything, and we are still focusing on the Gaganyaan mission over here. So we will be having a very good say in the space market. That is why government has opened the space market for the private entity and the foreign entity. Okay, now what are the revised FDI policy regarding the predatory investment? Okay, sometimes some companies come in order to invest in our country just to reduce the value of our own products. Okay, so our DPIIT, which creates the FDI policies in our country, has prevented the predatory foreign investment. That means you should not allow any investment which undermine your products, okay, or taking advantage of COVID to induce financial distress among Indian companies. Okay, so because there is a lot of Chinese investment that is coming, like around 1.6 billion in 2014 and at least 26 billion in 2019. Okay, especially in technology. You know, a lot of technology startups are there where a lot of funding is coming from the there's a lot of some funding is coming from the Chinese companies. So if we go by that, like how these Chinese companies are doing predatory pricing, you see a lot of Chinese investment that is coming, like, you know, Big Basket, right? Big Basket is there, right? Then you know Paytm, right? You know Paytm. From all these are getting financial from the Ant Financial Services of Alibaba, right? You know Dream 11, okay? Dream 11, right? Dream 11. Then then we have a Byju's, we have Snapdeal, they are all getting investment from the Tencent, that is again a Chinese investment firm. Then we have a Hill House Capital Group. What? Hill House Capital Group is there, which is investing in Swiggy. Then we have another house that is called Didi Shuzeng. This is investing in Ola and Oyo Rooms, right? Then we have Fortune, which is investing in Zomato. Okay, so these are all being invested in our country, so that is why government is trying to take a lot of control over these investment that are coming from either Bangladesh or Chinese or neighboring countries, which are explicitly uh, uh, interfering in the financials of our country and investing in order to take control the management level of initiative they wanted to take, and they wanted to control some of the biggest company of our own country. Okay, so again there's a revised policy because of the rising concerns, so the restriction on investment, so there is a restriction, so no resident entity from countries sharing land border with India can invest only under the government route. That means you have to take government permission, then only you can invest in whatever sector. Okay, then example, citizen or entry from Bangladesh and Pakistan can invest only under government approval. Then expansion, the scope has been broadened to include all neighboring countries through China is not explicitly mentioned, so even if you wanted to expand, then again you have to take permission. Okay, then transfer of ownership regulation, so transfer of ownership of existing or future FDI resulting in beneficiary operation falling under above restriction. Then aim is to prevent multi-layered transaction, because sometimes they do lot of multi-layering in order to hide out the real beneficiary. Okay, a real beneficiary is being hide out in this whole process. Okay, so either private equity or venture capital that is coming from China or other border sharing nation, they have to require a prior approval from the government for investment, including the pledge ones. Okay, so this is all related to the revised FDI policy. So we have a lot of rising China investment in India. Okay, we know that data security breaches are happening. The ByteDance 25 million investment in Daily Hunt aggregator. Daily Hunt is a news aggregator which influences the content and censorship of our country. Okay, then we have a role of state owned enterprises. Over 50% of the Chinese investment in India origin is from state owned or provincial governments. That means the government and state owned enterprises are doing investment in our own country. Okay, like we have a involvement of Chinese state owned enterprise in infrastructure project, that is again raising a question. Then made in China 2025. Okay, so we have a Paytm by like here Paytm is being funded by Alibaba, so we have already given lot of names to you, right? So Alibaba, then Zomato, Foxconn, and all these things are being Tencent for Dream 11, right? So these are all investing in India in order to take control, the strategic control over the market. Then scrutiny mechanism, Indian investment scrutiny mechanism may not be as stringent as those in the developing countries. So there is a need to have a scrutiny mechanism which can find out these predatory pricing and predatory investment. Okay, so we know that there are a lot of issues that has been raised. We know 5G networks are there, and like Huawei is coming and investing in our country, so we need to have look forward. Okay, and we need to make sure that what countries, which product, which things, which technology, which company from which country is trying to invest in our country, and what are their intentions. Okay, then impact on sensitive sectors, right? ByteDance, I told you, is investing in Daily Hunt. There is an app which is creating news in English and Hindi, and they are trying to influence, and they are trying to put a kind of a surveillance in the Indian news market and try to influence the Indian market. Okay, so this is the Chinese investment and implication on Indian market. So this is what the foreign investment that is impacting the Indian market. Okay, so what is the challenges in implementing the foreign direct investment policy in our country? What are the challenges that we are facing? So now, what are the challenges in implementing foreign investment in our country? Okay, so first of all is the funding for the startups. There is if we go by the funding of the startup, a lot of funding that is coming from the USA or China or Japan. Maximum funding is coming from all these places and Mauritius. Okay, we have a lot of unicorns and very small smart startups are there. They are getting a lot of funding, but sometimes there is a investor discouragement that is happening. Okay, so they have to focus on like how we are going to provide proper funding to the startups, how government can provide these investors with a easy go process for investment. Okay, we know we have a lot of unicorns are there, like Paytm, Zomato, Big Basket, Dream 11. Okay, so we have lot of prospects under these unicorns, but if government does not come with a proper policy, there may be a chance that we may lose. So we have also started losing in Byju's. Byju's and Paytm has already fallen apart. Okay, earlier a Paytm, which is of like $1 billion company and world largest edtech company, now has fallen into the rattles like that. Okay, into the floor, right? So we need more and more proper funding processes, and so that investors are very clear about the investment way, through how we can do the investment, how we can take out our investment, and what is that. Okay, so need more and more clarity regarding reporting mechanism, who will be the beneficiary group, who is going to be the ownership, like under whose ownership is being divided. Okay, so there should the ambiguities that are there has to be totally removed. All the obstacles that are coming in the implementation has to be removed. Okay, then allegation of norms floating by China always allege India, that India provide lot of barriers to the investors from specific countries, that is the violation of the WTA norms. Okay, so China keeps on blaming us for discriminatory barriers. Okay, but India always said that we are not following all these practices, but it is our duty that our own market and our own companies remain protected from the unnecessary predatory investment. Okay, so that we are not even hurting the WTO rules, at the same time we are protecting our own companies and also allowing the foreign investment to come into place. Okay, then spillover effect on the neighboring relationship. So if we are extending the restriction on all land border sharing countries, okay, it will indirectly affect the FDI from other nation, like Myanmar is there, then Nepal is there, and then various other places are there. Okay, so if we are specifically targeting certain country like land bordering India, so we are specifically targeting that we don't want it FDI from these. Also we wanted to more scrutinize these places, so we are indirectly targeting these countries, like those who are the bordering countries, that they are doing some certain wrong to our country. Okay, so maybe some countries are there who are doing wrong to us, but it is not like all the countries are doing wrong to us, right? So we do not have to put that word like all land bordering sharing countries. Okay, so this is a totally vague and very severe line that is there, which is hurting the diplomatic relations, and it may have a geopolitical implication in the near future. Okay, then what are the recent initiatives that government has taken in order to promote? So FIs, government has are entitled to establish or incorporate outside India that invest in the market, right? So now FIs investments are treated as hot money. Okay, FIs can invest all of a sudden, they all of a sudden take out their money. Okay, so there is a difference between FPI, foreign portfolio investment, or we call it as FFI, or FDI. Okay, so if there is an investment of up to 10%, they are categorized as FPI, and if there is more than 10% investment in any project, that is considered as FDI. Okay, so FPI is more volatile and FDI is more stable. Okay, so now we have even done recent initiative to promote foreign investment, that we have expanded the scope for qualified foreign investor scheme. Okay, we have a qualified foreign investor meeting, so they can invest directly in Indian mutual fund that we have opened for them. Okay, so that definition of qualified foreign investor has also been expanded in June 2012. Okay, here we are including the resident and member countries from the Gulf Cooperation Council and European Commissions. We have also included over here. That means we are expanding the scope of investment in our country. Okay, and then we are also categorizing NRI investment as domestic investment. Okay, Okay, so we have, even there is a proposal that we should treat the NRI investment as domestic, so that they will get same benefit as domestic investor. Okay, so this is again to increase the scope. So there is a proposal to treat NRI investment as domestic. So again, there is a talk that is going on regarding this. Okay, then what are the further steps that we can take in order to enhance the foreign investment? Obviously, making infrastructure project commercially viable, so we have to have a regular loan servicing, sustainable development of infrastructure, like we have to keep on appraising the project, we have to re-accessing the project, rebidding the project. Okay, keeps on doing it. Then greater state government participation has to be there, which is very crucial for the development of the project. Okay, like law enforcement, land acquisition, environmental clearances. Okay, so states have to do a more and more proactive participation. State government has to do more and more proactive participation over here. Then we have to improve the efficiency of the corporate bond market, because corporate bond market is a place where we can raise ample amount of money and resources, but that has to be properly streamlined. Okay, because they will be helping in providing much more money than bankings. Okay, so we need a coordinated and regulatory effort in order to properly enhance the corporate bond market, and we have to make sure that how we can standardize the whole process, where we can get institutional investor like insurance company, pension fund companies, in order to invest in these areas. So we will be able to release much more funds from the insurance and pension fund companies. Then credit enhancements are there. Okay, credit enhancement mechanism should be there, which can mitigate investor concern about the credit risk. Okay, we should be providing ratings to the various type of infrastructure project, like we do for rating companies are there. Okay, so we can provide A rating, triple A rating, B plus rating, B minus rating, like that. Okay, so it will help in facilitating, like the companies can come and they can raise the capital. So any A rating company is there, they can easily get the fund. Any B rating company is there, they can get the fund in a slightly more difficult way. Okay, so credit enhancement and rating mechanism has to be put over there, so that infrastructure project has to be rated based on the way it is working, based on the type of finances, based on the way of its clearances, based on the way it is like efficient way of working. Okay, so rating has to be given, so based on that more and more money can be generated over there. Then proper simplification of the procedure. There should be no tedious huge list of procedures and documentation has to be there. So there should be a single window dashboard has to be created. Okay, dashboard has to create, which has to be worked over it. Okay, so any related to land acquisition, object or clearances, water, or any mega projects are there, which is related, like various type of clearances are there: road clearances, electricity clearances, forest clearances, and environmental clearances, and various other clearances are there. Because of that, we have to take a lot of clearances, and because of that, because of unnecessary time, and it reduces the efficiency of the project, and obviously it lead to the cost overrun. Okay, so there has to be an initiative that has to be created to, if we wanted to attract the foreign investment, we have to enhance the efficiencies of the investment channels. How we can increase the efficiency of investment channel? By providing more simplification and smaller procedure for finding and investing in any places or any infrastructure project. Okay, so these are all the initiative that government is doing to promote the foreign investment. So this is all for today, guys. So thank you so much. I hope all of you have enjoyed. Thank you so much. I'll be coming with next lecture. Thank you. Bye bye. Take care and have a good day.